Statutory liquidity ratio is the minimum percentage of a commercial bank deposit that must be maintained in the form of cash, gold, or government-approved security. It is mandated by the Reserve Bank of India to regulate liquidity and ensure financial stability. The main objective of SLR are to control credit flow, manage inflation, and ensure the solvency of banks. Its major components include liquid assets and net demand and time liabilities of banks. What is statutory liquidity ratio? Statutory liquidity ratio SLR is the minimum percentage of a bank's net demand and time liabilities (NDTL) that must be maintained in the form of liquid assets such as cash, gold, or government securities. It is prescribed by the Reserve Bank of India as a tool of monetary policy. Unlike CRR, SLR is maintained by banks with themselves and not with the RBI. SLR helps control credit growth, ensure bank solvency, and maintain liquidity in the economy. Statutory liquidity ratio objectives. The statutory liquidity ratio is maintained to regulate the lending capacity of banks and ensure financial stability in the economy by mandating banks to hold a portion of deposits in liquid assets. RBI control credit flow and inflation. The statutory liquidity ratio is maintained to regulate the lending capacity of banks and ensure financial stability in the economy by mandating banks to hold a portion of deposits in liquid assets. RBI controls credit flow and inflation to prevent excessive credit creation and overlending by banks, to control inflation by restricting liquidity during inflationary periods, to encourage banks to invest in government securities, to ensure solvency and financial stability of banks, to regulate money supply as a tool of monetary policy. Major components of statutory liquidity ratio. The statutory liquidity ratio is calculated based on a bank's net demand and time liabilities and the liquid assets it holds. These components together determine the minimum liquidity that banks must maintain as prescribed by the RBI. Liquid assets. Assets that can be easily converted into cash, including cash balances, gold, treasury bills, government bonds, government approved securities, and securities issued under market stabilization scheme and market borrowing program. Net demand and time liabilities. Total liabilities of a bank payable to the public. Demand liabilities. Current deposit, demand draft balances in overdue fixed deposits and the demand portion of saving banks deposit. Time liabilities. Fixed deposits, time portion of saving banks deposits and staff security deposits. Difference between cash reserve ratio and statutory liquidity ratio. Cash reserve ratio and statutory liquidity ratio are quantitative monetary policy tools and used by the RBI to control liquidity and credit creation in the banking system. The difference between the cash reserve ratio and statutory liquidity ratio has been highlighted below.